Hey guys, Max here, and this is, of course, your daily market update for yesterday. And it is now the first day of the month. So today we're not only going to look at what happened yesterday, but then just briefly recap what happened over the last month and where we are for the year so far. So, how did we do yesterday? Well, as you can see, it was relatively red, but it wasn't an awful day. The S&P 500 fell by about 0.6% by the end of the day, so a decline nonetheless. And yes, most stocks here are red. There are a few outliers like Google and Amazon up by 4% and 1% each, but most companies fell by a modest amount for the day. The Nasdaq 100 fell by just a little bit less than the S&P, outperforming the broad-based index. It fell by 0.4%, and then the Dow Jones did a little bit worse as energy companies and utilities and real estate and healthcare didn't perform brilliantly. So the Dow Jones fell by 0.7%. Now, across the rest of the world, it was a similar sort of story for the most part. Stocks didn't do brilliantly, but they didn't collapse overnight. This wasn't a negative 5% day or anything. It was just a slow, steady decline across the board. The Stoxx 600 index fell by about 0.7%. The UK's FTSE 100 just fell very slightly at 0.1%. You can see that Asia actually did okay with some bullishness in Chinese markets in particular, but for the most part, stocks were red. Now, in the world of currencies, we really didn't see much of a change at all. The dollar spot index was actually just not changed at all. The euro is still sitting at about $1.07, and the pound is still sitting at about $1.26 each, so no real major changes there. It was a similar story for the bond markets as well. The US 10-year Treasury yield is sitting at 2.86%, which is pretty much where it's been hovering for actually most of the last month. The German 10-year yield rose by about 1 basis point. The British 10-year yield rose by about 3 basis points. So small outflows from the fixed income asset market, but nothing major. Unfortunately, in the world of oil and energy prices, things didn't get any better. Of course, over the last week or so, we've had a pretty strong energy price spike, in particular with oil prices. Right now, at the time of me making this video, WTI crude oil is still sitting at $117 a barrel, and Brent crude is sitting at 118, so no good news there. Energy prices are going to remain high. And then we saw gold prices actually fall by about 1%. They're now sitting at around about $1,835 an ounce. Now, in the world of crypto, what happened? Well, it was quite a tame day. Bitcoin held on to the gains that it made the day prior, currently sitting at about $31,700. Ethereum lost some of its gains. It's down about 1% and sitting just below $1,950. Altcoins, for the most part, were okay, not really moving any major amount. ADA, which rose by 30% the day before, fell by about 5%, so it pared some of those gains, but really nothing major. Stablecoins are still maintaining their pegs. There is a little bit of fear surrounding Tron because they've just come out with an algorithmic stablecoin, which will suffer from the exact same exploitable flaw that UST suffered from. And so there's a lot of people talking about that and discussing that and saying that actually that's a pretty bad idea and we might be seeing a Luna 2.0 problem arise over the coming weeks. So it's the end of the month then. What happened to equities over the course of the entire month? Well, this right here is every stock market combined together listed over the last month. And you can see quite clearly that it was quite a mixed bag, but some specific industries did well and some did poorly. Consumer defensive in particular did really quite poorly as we saw inflation eat away into people's disposable income. So they were forced to spend more money on essentials like food and gas for their cars and less money on, the things that they just pick up in aisles. So we saw Walmart fall by 16%. We saw Target fall by 30% and Costco down by 12%. Consumer defensives really had quite a bad month. Some parts of the tech world did quite poorly as well, in particular software as a service companies. As you can see, this big red square here, Tesla did quite poorly and fell by about 13%. But then on the plus side, what went well for the month? Well, financials were really quite strong. JP Morgan's up about 11% of the month, and energy, once again, energy stocks have outperformed almost everything, rising by anywhere from 10 to 20%. As we are about halfway through the year then, the S&P 500 is down by 14% year to date, and the Nasdaq is down by 24%, with tech stocks performing far, far worse than the rest of the indexes. What we've seen over the last month in particular is just a lot of volatility, wild swings upwards and downwards, But actually for the month, the indexes really didn't do too poorly. The S&P was only down by 0.5%, and the Nasdaq was only down by 3.5%, which across the month really isn't too awful. It does seem very clear to me, at least, that we are still in this bear market, that no, we probably haven't bottomed yet. We're probably just seeing a small rally, a small bull trap, and we should expect to keep seeing small rallies and bull traps as we go along. But the conditions which are dictating this market haven't changed at all. Inflation is still very, very high. The Federal Reserve is still tightening the monetary environment. Quantitative tightening is actually about to start. Today is the first day where the Federal Reserve is going to be selling off assets as opposed to buying them up. At first, at a rate of about $1.5 billion a day. But by September, that rate is going to reach $3 billion a day. And then to make things even worse, the economy is starting to show signs of straining, with things like Walmart and Costco and Target reporting poor earnings because people are just running out of cash. The actual bad conditions which are dictating this bear market haven't changed at all, or they haven't changed for the better. The ones that have changed, the economy and the state of people's incomes and their disposable incomes, well, that's actually getting worse. So that's basically why, no, I don't think this is the bottom. I don't think this rally is here to stay. Now, as I just mentioned, this is the first day of real, true quantitative tightening with the Fed selling off assets. And so we're about to learn whether or not this will be effective in raising yields, whether or not it will be enough selling pressure to dictate the yields that we see on things like the 10-year Treasury. The counteracting force to the Fed selling off their assets and creating this whole load of selling pressure is that stocks are doing really quite poorly and people are worried. So investors are going to be looking for safe haven assets for a flight to safety, and bonds are one of the safest assets in the world. So they're going to be moved into that market while the Federal Reserve is going to be moving out of it. What we don't yet know is which force is going to be stronger, and so which side will have net positive effects. Now, yesterday, I mentioned slightly offhand that President Biden and Jerome Powell were going to be meeting with each other to discuss inflation, basically to discuss the Federal Reserve and its actions and what can be done and what is done and all things like that. And yesterday, we saw that meeting, and really, it was absolutely atrocious. We learned absolutely nothing, and nothing has changed at all. What basically happened was Joe Biden came out with a piece of paper where everything was written down for him, and he spoke for just over a minute, basically saying a few things. The first thing he talked about was the fact that reducing inflation is his main concern, his main priority right now, and it is what his administration is focusing on the most. He then made a slight caveat and basically said that actually it's not really his job to reduce inflation, it's the Federal Reserve's job to reduce inflation. So if it's their job to keep it low, then it can't possibly be his fault that it's high. So please don't blame me, I'm just the innocent man who is trying to assist things in any way possible, but really it's that man over there, Jerome Powell, who has all the power here. Don't take it out on me. Then finally, the other thing that he spoke about was about the Federal Reserve's independence and how he thinks it's a very important thing, and that actually that's his job. His job regarding inflation is to leave the Fed alone and allow them to do their job of reducing inflation. Now, to be perfectly frank, this was some of the worst political grandstanding that I've seen in a while, and absolutely nothing of substance was said at all. I will show you guys the full video at the end of this video so that you don't have to look through it if you don't want to, but it's pretty awful. Now, there are about three things going on. The first one, as I just mentioned, is Biden trying to pass on blame. Obviously, his approval ratings are pretty damn poor right now, and he's at risk of losing his congressional majority. And even with that majority, he hasn't been able to get much done. So that would be a really bad blow to him. So he's trying to pass that blame on from inflation onto someone else. Now, the second thing he's trying to do is he's trying to emulate Ronald Reagan. Reagan back in, I believe, 1984, when he met with Volcker to discuss inflation because it was just the biggest topic on everyone's minds. And Reagan back then wanted to let everyone know that he's taking this seriously. Biden's trying to do the exact same thing here. It's very rare for Biden and Powell to have a special meeting like this. It isn't at all usual. It happens once a decade kind of thing. And so, yeah, Biden's trying to emulate that Reagan effect and tell everyone and reassure everyone that he's serious. Now, the final thing that Biden is trying to do is he's trying to present a a juxtaposition between himself and President Trump. If you remember back in 2018, Trump was actually really quite critical of Jerome Powell and how he refused to raise rates as the taper tantrum started. Now, that was very unusual for the time. He was the first president of the US in history to take an opposite view of the Fed. Everyone else in history has just said, okay, Fed, go do your thing, do your job. I will speak to you in private, but I will not make any public comments disparaging what you're doing. Trump took the complete opposite direction, and Biden yesterday was making a point of saying that no, he is the status quo. He's the normal president. He isn't shaking the carriage. He's not rocking the boat or anything like that. He's just going to let the Fed do what they want, and he's not going to make any disparaging comments. Now, following that, the other interesting thing that came up yesterday was we heard from Yellen, who is also part of the Fed and has also been on side with Jerome Powell over the last couple of years, in particular, talking about how inflation was never a threat, it was never going to happen. And now finally, she's come out and said, yes, actually, I was wrong. Inflation was obviously coming. It's here now. There's no more denying it. Transitory was a bald-faced lie. Now, this might seem great. It might seem like, okay, she's finally admitting to her faults, but in reality, she's still just trying to shift the blame onto other people, talking about how she was wrong, but it still isn't the Federal Reserve's fault that inflation is here. As you can see here, she says that, yes, I was wrong about the path that inflation would take, but then she puts out a strong caveat there and says, actually, there have been unanticipated and large shocks to the economy that have boosted energy and food prices and supply bottlenecks. Basically, she's saying, yes, I was wrong. I did get my prediction wrong regarding inflation. But the reason there's inflation is because of COVID lockdowns, because of supply chain crises and all of these supply side shocks. And it had absolutely nothing to do with the Federal Reserve printing trillions and trillions of dollars. Of course, we know that this just isn't true at all. Modern monetary theory does not work. It causes inflation. Of course it does. I can't believe we ever allowed it to be attempted, but we do now know categorically that yes, printing money will cause inflation. Yellen, of course, doesn't really want to admit that because she was one of the proponents for printing money. And so admitting that would actually be taking fault. She would be saying that, yes, not only was I wrong about my prediction for inflation, but actually it's my fault that it's here as well. Finally, she then went on and spoke a little bit about the threats to the economy, the threats to the market, and things like the slowing job growth. But really, I don't blame her for what she has to say here. She is kind of forced to take this position. Basically, she's saying that yes, things aren't brilliant right now. Yes, markets are dropping. And yes, the monetary environment is tightening. But actually, the economy is quite strong, or at least it's coming from a strong position. So the Fed does have quite a lot of leeway. I don't think she necessarily believes everything she's saying here, but she can't just come out and say that actually a recession is right around the corner. She clearly has to play the game a little bit and pander and say that she's not 100% sure, but that the Fed has their mandate to fight inflation. Because if she comes out and says that, you know what, a recession is here, then there's going to be widespread outcry for the money printer to be turned back on. And this will just make the crisis so much worse in the future. Now, that is pretty much it for the day. I'm going to play for you in a moment the full clip of Biden speaking. Really, as I said earlier, there's nothing to be learned from it, so I don't blame you at all if you click off. He literally sits down with a piece of paper that presumably he didn't write on in the first place and reads out what he's been told to read for a minute and a half.
I'm meeting with the chairman today and Secretary Yellen to discuss my top priority, and that is addressing inflation in order to transition from historic recovery to a steady growth that works for American families. Excuse me. And my plan is to address inflation. It starts with a simple proposition: respect the Fed, respect the Fed's independence, which I have done and will continue to do. My job as president is not to not only nominate highly qualified individuals for that institution, but to give them the space they need to do their job. I'm not going to interfere with their critically important work. The Fed has dual responsibilities: one, full employment; two, stable prices. Chair Powell and other leaders of the Fed have noted at this moment they have a laser focus on addressing inflation, just like I am. And with a larger complement of board members now confirmed, I know we'll use those tools in monetary policy to address the rising prices for the American people. So I look forward to Chairman Powell's continued leadership at the Fed, and I look forward to the Senate considering my final nominee to the board, Michael Barr, in the near future. And that's why we're meeting, folks, and thank you for coming in.
Thank you.
Mr. President, why do you think there is
Let's go, thank you, let's go, guys, thank you, come on, let's go, come on, guys, thank you, let's go.
Whose fault is
Thank
all
you,
this?
let's go, come on, guys, let's go, thank you, let's go.
Mr. President, whose fault
Thank
is
you,
all this?
let's go, come on, guys, let's go, thank you, let's go, come on, you guys, let's go. Let's go.
If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. They can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, a site that allows you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you think that crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.